Well, very exciting to have all of you join us here during your lunchtime. Welcome to our live session on emergent risk, and this is organized by the Cyber Data Risk Managers. So my name is Shamane Tan, and I am the Executive Advisor at Privasec. I work closely with the Chief Information Security Officers to help bridge their business gaps. But I'm glad to be a host here for today. And before we start, we would just like to begin by acknowledging the Gadigal people of the Eora Nation and the traditional custodians of the land on which we gather today, and pay our respects to the elders, past and present. We extend the respect to the Aboriginals and Torres Strait Islander peoples here today as well. And Michelle, you would like to say a few words too?
Yes, thank you, Shamane. I just want to extend what you have said to also recognise the people of the Kulin Nation, to represent quite a widespread of Melbourne people on the call as well. And again, extend my respect to elders past and present, and any Aboriginal and Torres Strait Islanders who may be with us today.
Thank you. So thank you, Meena, for first of all inviting us to your show. So for those who don't know Meena Wahi is a director at Cyber Data Risk Managers, and she's a recognized digital risk insurance expert. Perhaps Meena, in a sentence or two, you can tell our joiners and our listeners here today briefly about what do you do and what does the company do before I move on to introduce the rest of the panel.
Sure, thank you, Shamane. So we like to be at the forefront of understanding risk as it is evolving, and helping our clients procure the right insurance policies. So therefore, we have very good relationships with insurance companies all over the world, and we understand risk. So we try to match our clients' needs and their risk with the right insurance policies.
Excellent. Thanks a lot, Meena. And I'm really excited because we have a very, very experienced panel here with us today, as we are going to be diving into the different perspectives for super boards. So we also have with us Teresa Dyson, and she has a broad portfolio of directorships, including being a non-executive director and the Audit and Risk Committee Chair of 7 West Media, for those who recognize the name, and Ginex Power. Teresa is also the Director of Consolidated Tin Mines, Energy Queensland, Energy Super, Power and Water Corporation, and the Gold Coast Hospital Health Board, just to name a few. It's quite a mouthful. Teresa, do you want to share with us anything or highlight some of the interesting work you've been working on?
Sure, thanks, Shamane. Look, it's a pleasure to be here. So I do have a group of different types of industries that are in my portfolio. In the finance sector, which is, I suppose, most relevant for today, Energy Super is an industry super fund. We've got about $8 billion of funds under management, about 45,000 members. And as you said, I chair the Audit and Risk and Compliance Committee for that, as well as being a non-executive director. Just also, I suppose, in the finance sector that might be relevant, I'm on the board of the National Housing Finance and Investment Corporation, which is a federal government body that it was originally set up to fund investment into community housing projects, and then we issue bonds out into the debt capital markets. Most recently, we've just done a $350 billion debt. That's our third bond raising. And we've also been administering the first home loan deposit scheme as of the 1st of January. So that involves quite a lot of interaction, and most of it in a digital space between us and all of the retail banks that have been able to offer those first home loan deposit guarantees to first home investors, which is pretty exciting. And the other one in the finance space is that I'm also on the Foreign Investment Review Board. So we have a look at all of the investment that comes into Australia. It's an international economy that we have. So there's a lot of focus that we have at that level on data and cyber issues, just from an investment perspective, but also in the way that all of the investment fits together as well. So, but it's an issue that applies across all of the sectors that I'm involved with as well.
Wow, excellent. Thanks, Teresa. And next up, we have Romain Rallu, who is the CEO of Privasec, and also the same company I represent. So Romain is very renowned in our industry for his expertise in the governance, risk and compliance space. He has an extensive experience in establishing and implementing information security strategies, frameworks, governance architectures for both medium and large organizations in APAC and Europe. He also gets invited regularly to run boardroom workshops, assisting many varied operational business teams. Romain, do you want to add anything?
Yeah, just in short, well, first, happy to be here, of course. Just to say that Privasec is now, we now have 6 offices spread out Southeast Asia and Australia. Yeah, you said it all, I think. Thanks, Shamane.
No worries. Yeah, it's been an incredibly busy season for us, actually, I might add, with a lot of demand for like the GRC consulting, audits, technical assurance, drone security. It's crazy. So anyway, really good to have you on the panel with us. And the last but not the least, definitely incredible lady, we have Michelle Beveridge. She's an experienced C-level executive and board director for more than 15 years. So Michelle is a CIO at Intrepid Group and the director and chair in various boards, including REI Superannuation Fund, Vernet, Australian Computer Society, and the Queen Victoria Women's Centres Trust. So Michelle's skills and proactive style actually has contributed a lot to revenue and the EBITDA growth and long-term sustainability. In the past, Michelle has initiated and implemented significant business change programs, and she was named the CIO 50 Awards in 2016 and 2018. Michelle, anything else you would love to add and share with us today?
Thank you, Shamane. I don't think there's much more I can add to that lovely introduction. Thank you. I think similar to Teresa, I'm making that transition to full portfolio career. So my Chief Information Officer role at Intrepid is actually no more, thank you to COVID-19. But I think that years of experience in information technology and looking at the issues we're going to be talking about today adds to the conversation, as well as nearly 3 years on REI Super's board, which looks at the real estate industry, specialist in that industry. And I'm actually deputy chair of that board now, so that's been a thrilling change as well.
Thank you very much for sharing that, Michelle. And, you know, before we're going to dive into today's topics, right, for those, because we have a lot of experienced people here on the panel, if you have any questions as well, feel free to type that in the chat box, and I will be going through the questions later, and we'll aim to have some time for Q&A. Okay, all right, so we're just going to dive straight into this now as we explore how is the financial services sector managing risk, you know, given that there's always new risk that emerge and cease. So how are the boards of super funds determining which risk will be dominant in the next 5 years? So maybe perhaps, Michelle, you can kick it off by sharing some of the emergent risk and challenges of the boards in managing them.
Thank you, Shamane. I think the certainly for every board, risk is one of the key things that the boards need to consider, and that's no different in the superannuation industry. The COVID-19, of course, is the big topic of conversation at the moment, and for super funds, it's the long-term impacts of COVID as well as the short-term changes that we've had to make to the operations. You know, things like the early release payment program that's on at the moment, that has a long-term impact on member outcomes. So we're really looking at, you know, how can we help our members ensure they do have long-term superannuation, as well as, you know, helping them through the current crises. There's also things like increased regulatory attention. We've had the Banking Royal Commissions. We've had, you know, more and more compliance requirements coming through from the regulators. And that becomes a bit of a balance risk for the superannuation funds, because all that additional compliance requirement means that, you know, it's more administration cost. And you want to make sure that those costs don't get too high compared with the benefits of that regulation. So we're constantly looking at that side of things as well.
Meena and Roman, do you have anything else you want to add to that?
No, I mean, for my side, I guess, from a cyber perspective, cybersecurity has now, I'd say in Australia for the last 5 years, been a strong topic. Nobody would argue that it's not a risk or not something for the business to consider. It used to be buried under IT, but it is no more. I think what we're seeing is the appetite for board to understand, or to the maturity in appreciating cyber risk has evolved, and we work with a number of supers and FSI clients, and what I'm seeing is that when they define the risk appetite, typically on a yearly basis, I'm seeing a greater appreciation from the board to try and understand really what the cyber risk means to their business. And I've even can think of one substantial super where the CIO took the chairman to a cybersecurity conference in Singapore before COVID-19. And for the chairman of that board to be able to take a couple of days off and attend that conference to educate himself, I think was brilliant. Very telling.
Yeah, I agree. I think how we were defining cyber risk and the other emergent risks is shifting now as these risks become more mainstream or dominant risk, and how you treat emergent risk sort of also changes as those risks become more dominant, and you learn to live with them and see them as more, day-to-day risk. So I think super funds and financial services sector have been at the forefront of adopting digital infrastructures. And digital infrastructure, if you sort of understand what it means, is really operations and customer experience combined over the internet to deliver superior value, right? And once you do that, you start looking at boundaries shifting, but then comes the conversation around reputational risk, data privacy risk, and even online fraud becomes part of the conversation. So, by virtue of adopting a new strategy, boards now also have to accept the risk that comes with adopting digital strategies. And I think, therefore, we see more emergent risk being part of the conversation. And these risks are different, and they need different kinds of treatments.
I think it's a very good point there around emergent. When we say emergent risk, we also need to look at fast-changing risk or fast-evolving risk. Because in the case of, like you mentioned, of reputational risk, particularly as it relates to cyber, the market perception of what is acceptable and not acceptable for a company has changed dramatically, right? So 5 years ago, 10 years ago, somebody got breached, you just didn't understand what it meant to you. Then you found it completely unacceptable. And now people start to realize that it's a fact of life, it's unavoidable. All we can try and do is minimize it. And they start judging, the companies on their response to a breach, and not so much, focusing on blaming the breach itself. So the landscape, the point I was trying to make is the landscape is changing really fast. And once you have a risk that's emerging, it's also very fast changing. So you need to appreciate it, but also continuously step on top of it because the market expectations do shift very quickly as well.
Yeah, that's a very good point. And maybe, Teresa, why don't you address the next one, right? Have organizations in the financial services sector become more accepting of risk? Not just in particular to cyber risk, but how do they go about in terms of defining their risk appetite? What's your take on this?
So I think there has been a lot of attention on risk generally in the sort of, well, it's always been a key feature of what boards are supposed to do, but I think the understanding of the trade-offs and the balances between risks that you are prepared to take to enable you to do business, to be able to increase your different sort of offering. I mean, moving into digital platforms is a risk in of itself, but if you don't, then you're paralysed in terms of doing business. So you have to sort of understand what the balance is in terms of risk that you're willing to take, and what mitigations and what factors you can put in place that will manage it to a level that you're comfortable with. Particularly in the super industry and more broadly the finance industry, because the nature of a lot of the business is as a custodian for other people and looking after other people's money. There's usually a very low risk appetite that sort of stems across a lot of the activity, because where you might have a commercial business that might be willing to take a bit of a bet or a punt on something because the opportunity might be very large, but understanding the risk might be large. When you're looking after other people's money as their custodian, and particularly when it is going to fund their life in retirement, then I think it is a much lower risk appetite that is typical across the board. But that doesn't mean that super funds again need to sort of stand still and not be able to develop business operations that suit the times and that make the service to members, because it's all about members first and members' interests at the core of all the decisions. So it's just a balance, and I think that boards generally are becoming more sophisticated about and more mature about having those discussions and understanding what the trade-offs and the differences are.
Yeah, I think if I can add to that, Shamane, as well, I think I have seen the difference with superannuation boards compared to other, kind of more commercial, if you like, boards, because the attention to risk at REI Super is much heavier in that, low to medium appetite to risk. The whole board goes through the risk framework at least annually in detail. There's a dedicated risk committee which quarterly goes through the risks. We've just in fact finished doing the annual review of the risk framework, so it's right up to date with all the COVID-19 kind of risks in there. So it's a big part of the financial services industry.
That's really good to know.
Yeah, I
Romain?
certainly second that. I was about to just say that that's exactly what we see as well. When we look at the fairness and the with which different lines of assurance are being set up in FSI clients. FSI clients have a much better maturity of risk and control, so risk and audits, right? That balance there, and whereas a lot of I guess non-financial enterprises don't necessarily have that level of appreciation. But it goes back down to what Teresa was saying around having a low risk appetite. And I think it's critical that you can only afford the low risk appetite when you really understand the risk you're taking. And I've seen, I think in a few years ago, I was seeing people stating they had low risk appetite, but really not really fully understanding, appreciating what it meant, and not realizing that they actually had risks that they had that were significantly above the risk appetite here.
So true. Meena, do you want to add a different perspective to this?
I think I will disagree just a bit, because I feel that by virtue of accepting digital strategies, businesses in general also become accepting of risk, because when you transact online and you conduct a whole lot of activities and have interfaces that are online, you require a greater diligence of the risk. And therefore your risk management strategies have to be more sophisticated. However, by adopting something new like digital, you are taking the leap of faith by saying, yes, we do accept a level of risk by doing so. So, your professed risk appetite may be low, which is right, but in a sense, by adopting a certain strategy, you do accept the inherent risk, which may be higher than before.
And earlier we talked a bit about APRA. So APRA, as we know, is imposing guidelines and greater responsibility on board members. So it'd be interesting to hear from the rest of you, what are your experience when it comes to complying with the Prudential Standard CPS 334 information security? So Teresa, do you want to go first?
Sure. So we've been closely tracking CPS 234 now since it was announced, and obviously now that it's officially up and running as of this month. So it's been certainly something that we've had internal teams working on, but also it has featured in our board deliberations and at the Audit, Compliance and Risk Committee that I chair. We've just completed an internal audit on our compliance with CPS 234. And I suppose our readiness to continue to evolve with it. So, which came out well, which was pleasing from a board perspective. But a lot of work's gone into that as well. And, we're sort of very mindful of the fact that, we use third-party providers. We've got third-party administrators. So it's not just our organisation that has to be vigilant in relation to the way that we manage data. And CPS 234 gives us a framework to measure ourselves against that, but we also have to extend that in our contracts and in our reviews and discussions with our third-party providers to make sure that there's not a weak link in the chain, and some of the providers are not quite up to scratch with the same level of diligence around complying.
Very well said, Teresa. I know, Romain, you have lots to talk about third-party providers.
Yeah, because it's close to my heart. 6 years ago, I was at a conference in the Gold Coast, and there was about let's give it like 150, let's say, senior IT manager and CIOs and the like. And I said that supply chain security was something that was going to get hotter, etc. And I was almost booed off the stage, right? So nobody cared back then. And so what APRA's done is really make that a requirement for people. I think APRA's great because it scares people. It's weak in the sense that there's still a little bit of confusion around what level is just required by APRA. Because when you read the CPS, it's not always immediate to people who don't have a lot of experience. We certainly see a rise in APRA internal audits, like Teresa mentioned, a service that we deliver. But what we're seeing now is poor vendors that are being inundated with due diligence assessment and security assessment. And we're on both sides, because we do it on behalf of our clients, and then we also respond to them on behalf of other clients. So it's raised the bar significantly. I think a bit more information. I think the market will mature over the next year or so as to where exactly is the bar to meet. But I think it's been a huge positive impact in the market from our perspective. I'm not saying that because commercially we sell more services. I mean, because supply chain was just it was an easy way to outsource and forget. And people always pass on the fact that they still remain accountable, even though they've transferred the risk. And I think that reminds them that now you're still accountable. You've got to do something about it.
Thanks, Roman. Michelle, what's your observation though, and your experience with that?
Yeah, it sounds very similar to what Teresa and Romain have just said. I mean, certainly we went through the same journey in terms of, looking at the 234, doing our gap analysis to see what we needed to fix. A lot of it was around documentation and getting the right policies in place. Again, we did an internal audit. We've got it now as part of our standard internal audit plan to have a look at the things that we've got in place and make sure that we're keeping compliant with the standard, but even going beyond, so that you've got that whole risk culture and information security embedded into the organisation, including the directors. We run regular security tests, the old spam test and those sort of things with the directors. And, it's a timely reminder that it's actually everybody's accountability for information security right through to the chairman. So we've been on a very similar journey.
You mentioned spam test, Michelle. Know-it-before was a company in the US founded by Kevin Mitnick, who was, one of the earliest and most famous sort of hacker, right, to put it in layman's term. It's now valued at over $1 billion, right? And it's a company that sends phishing emails primarily aimed at executives, but not only. So it tells you where the market is going, and there's a growing appreciation that humans are easier to exploit than machine in many cases. And people are definitely targeting people in board level position, executive level position, because traditionally they have been less aware than other people in the organization. So yeah, but that was a small segue there. You're changing.
Yeah, I'm actually quite encouraged sharing the conversation and your share your experience, because it shows that there has been this talk in amongst like the cyber industry where they feel like, okay, board members, board chairmen and all really need to we need to be talking more about cyber risk in the boardroom, right? Not just risk as a whole. And to hear you articulate that so well in terms of your understanding, and it just shows that a lot has changed and evolved over the years, where now this is seen as a really important thing as well. And speaking about that, I'm just wondering, right? Do you feel that the boards of the super boards, do they have skills and diversity for ensuring risk oversight of digital risk? Teresa and Michelle, free for both of you.
Well, okay, I'll go because it's very relevant to my position on the REI Super Board. I was actually recruited because it was recognised from our skills matrix that there was a gap in terms of understanding of technology and cybersecurity. So, they did an executive search, and after the appropriate due diligence, I was appointed to the board. So very much that making sure the diversity is there. I think the other thing that's interesting for us, and I'm sure Teresa's boards are the same, is a lot of directors have that whole lifelong learning as part of their sort of DNA. Nowadays, it is actually a requirement of boards to do a certain level of training. But I find my fellow directors are constantly sending me little articles about everything from, climate change to the property market to, superannuation issues to cybersecurity. So there's this constant lifelong learning and sharing of knowledge across the board, and that's essential for this space as well.
That's really good to know. Teresa?
Yeah, and look, I support that. I think having a skills matrix that you do sort of make sure that you've got a mix of different experiences and different expertise at the board level is important. We haven't gone through that process of appointing someone specifically with the digital experience. you know, we, as Michelle has said, everyone's very committed to the ongoing learning, but, you know, we're sort of also very encouraging of board members to challenge, to ask questions, to, you know, we're all sort of having experiences across all of our other commitments, boards or executives in the case of some of the other board members. So I think we're able to sort of see that depth of things that are going on, and, you know, we've got obviously internal, so there's perhaps a bit of a different approach that we've sort of taken in terms of just making sure that we're informed enough to be able to ask the robust and challenging questions, and then have a discussion about how we mitigate without necessarily knowing all of the technicalities as much as Michelle does.
Can I just add something that may not be very popular?
Okay.
I think the short answer to your question, Shamane, is that there is room for diversity. And I think that in the financial services industry, what I'm seeing sometimes, and that's, you know, the perception from us being provided to that industry, is that there's room as well for candidates that don't necessarily have years and years of board experience, but do have very relevant technical experience. And sometimes I feel that members are appointed because when there is an executive search, like Michelle mentioned, you know, the first thing recruiters will go is search for another board member. So sometimes it's staying in the same pool of people, and I think that it's good that to be able to recognize that on the things like digital and cybersecurity, you do need people that have current knowledge and expertise. And if they can be a board member, if they have been one, that's fantastic, but it won't always be the case.
Actually, that's a good point, because I'm completing my company director course from the AICD at the moment, and obviously hoping to get on boards. I have joined a bank branch. Bendigo Bank has a community branch network, and I'm on the board of one of those branches now. But the point that I'm trying to make is that I decided to go on that path because a few of my friends who are non-executive directors would meet me and ask me questions and say, oh, you know, I'm having a board meeting, and what should I be, you know, what do you think can be discussed? And I was giving them points like, you know, ask a question around supply chain risk, and if you know, you have discussed ownership of liability and risks across the supply chain with your contractors. And so I was having so many of these conversations, and I thought, oh, boards must, you know, boards must have a gap in terms of skills around technical and cyber. And it seems to be correct. I think there's definitely a gap there.
Yes, and hopefully more of this sort of conversations will help to bridge the gap, you know, and raise a certain level of awareness as well. But before I move on to the next question that I wanted to ask you, Meena, I would also just want to open this session up to the floor. Like the rest of you, as you're hearing all that's been discussed, I'm sure there's questions that's coming to your mind as well. So feel free to take advantage of that and, you know, keep your questions coming, and we'll get to them in a bit. Okay, so back to you, Meena. Really thought it'd be good for our audience to hear about like your experience specifically when it comes to risk transfer mechanisms for treating risk. So, you know, what do you think cyber insurance should provide cover for? Because that's the area of your expertise. And, you know, do you get multiple reinstatements on the policies and coverage for digital supply chain risk?
Yes, so one thing has to be clearly understood is that insurance is a treatment or a mechanism for transferring residual risk. Insurance companies all over the world would not accept risk of a business that hasn't gone through the conversation and the compliance around expectations of managing risk. So, you know, like Teresa and Michelle have spoken about how they've carried out their risk assessment exercises, set their risk appetites. That's actually a very critical process when it comes to risk transfer, because we like to see evidence of all that having happened, and the conformance to CPS 234 is evidence and posture of a business that is compliant and manages its risk. And we recognize that there's always a percentage of risk that's left, which you can't mitigate or manage, but can be transferred, or else some businesses might just like to accept the risk and not transfer it to a third party who's an insurance provider. So when we take on risk, especially when it comes to directors and officers liability risk and cyber risk, the evidence of that forms part of the conversation. So somebody like me who understands cyber risk would like to have an in-depth conversation and find out what the business is doing. But also we like to alert businesses and super funds and financial services sector businesses to the fact that there's emergent risk in terms of online financial crime. What about issue around loss of customers and contracts if there is a cyber incident, because you are a custodian of third-party data and third-party funds, but if they go missing because you have outsourced third-party data, your customers' data or your customers' funds to a third party, and the third party loses the funds or the data, then your customers will hold you responsible and you lose the contracts. So some of the progressive insurance companies from London are actually insuring for reputational loss, and under that they cover loss of contracts, loss of customers, and there's a lump sum payment around that, which is very progressive. They're also covering for supply chain risk, which is that any data that's lost by a third party, they would actually consider that as your loss, and the policy will trigger as you would have perhaps had a breach within your infrastructure as opposed to a third party infrastructure. And there's a greater recognition that privacy legislations which are global in nature may trigger. So we can't hold an Australian business insured. We can't just keep a business insured for local privacy legislations, but the global privacy legislations are now covered by a number of progressive insurance policies. But we like to see the corresponding DNO, the directors and officers policy cover, and the PI policy cover as well that a business has, so we can see that they talk to each other.
Michelle and Roman, do you want to add anything to this?
I think certainly from the cyber insurance, Meena's got a huge future for her business because there is such variation in the policies out there, and a huge variation in price. It's they've come a long way in the last 4 or 5 years. We've had cyber insurance for 5 years, and what we're seeing now is very different to what we saw 5 years ago. But it's still a very murky market to try and figure out where to go and who to go with.
Yeah,
I can only second that, and I think that people used to initially, when it came to the market, people thought it was silver bullet sometimes, and now they know it's not. But it's part of the essential baseline fabric of controls you need to have. And trying to subscribe to a policy with a good brokerage is just madness because there's so many variations, so many immaturity in the market, and we see sometimes different questionnaires that are being asked by the insurers to the potential insurees, and you can see the huge variation, the maturity of the questions being asked. You still have people going with 3 questions like, do you have antivirus? Which means what exactly, right? It's just such a broad, silly question. And people that have a much better appreciation, like Meena has, of cyber risk and what it really means and where it can really hit. So yeah, I wholeheartedly agree with what Michelle just said. And Meena's right in saying the word progressive. It's really about progressive insurances are the ones who are going to win this market, I feel.
yeah.
I'll just sort of add one extra thing to that. I mean, I think the level of maturity of the product is certainly changed since I've sort of been watching it. I mean, at the first, it was really a bit of it more treated as a subset of crime insurance or proceeds of crime. It just, you thought somebody might, steal some money and, you'd have to put a claim in and get it back, or, divert it to a, Brazilian bank account or something. And that was sort of as far as people thought. Those questionnaires that you mentioned, I know certainly in a couple of businesses that I'm in, they're going as far as really testing the human vulnerabilities and the sort of training that you have at the individual level, what sort of verifications and red events and hackings you sort of do to sort of try and do that, but really sort of targeting the training in relation to phishing and just clicking on things or multi factor authentications, just the vulnerability of passwords and things. So all of those sorts of things now are being very are being elevated in businesses, not only because of the businesses don't want to go through a cyber attack, but it's becoming important in terms of the level and type of insurances that they're able to access.
Yeah, and I think part of the discussions that I have with usually senior executives when I do like awareness sessions and so workshops like this is people who have a breach usually say we don't want to have a breach again, and I say, well, tough luck, you're going to have one. It's just unavoidable. It's like me saying I don't want to fall sick again. I will fall sick again. All I can do is boost my immune system, have my have my emergency numbers sorted. It's all about the response and my general fitness, right? Which is not the best, I'll concede. But anyways, the point being that yes, it's about breaches do happen, and we just can't hope that they won't, because it's a dangerous approach.
All right, and we actually have a question that came in from the audience, so thank you, Andrew. So his question is that it's fairly well accepted that COVID-19 wasn't embedded in the risk management frameworks, and then he wants to find out from the panel, right, what do you guys think about like the pandemic planning, right? Will that now be incorporated in risk planning practices and processes and frameworks? Maybe if you can just share a bit more detail about how you think that's going to pan out.
So maybe I'll just have a first stab at this because I feel quite passionate on the topic. Planning for scenario-specific planning is getting harder and harder. And if instead you break down your business in terms of assets, tangible or intangible, that can be impacted and levels of impact, you can almost, regardless of the scenario, trigger your responses. So pandemic planning is no different than any other sort of scenario planning. The question is, what is impacting within my business? What functions and assets do I lose? Or do I disrupt, and how do I respond to that? So that was my 2 cents.
I have a slightly different sort of take on it, I suppose. I mean, I think all businesses had business continuity plans, BCM management, and I think prior to this global event, people thought they would pretty much cover anything, and to a large extent, at a very internal sort of looking. They were effective. I mean, certainly now in Energy Super, using as an example, we had a very effective plan to get people off site and all that sort of thing. So that was part of our business continuity and backups of information. What I think wasn't contemplated was the combination of the global impact, the impact on the economy, complete shutdowns of cities and states and countries. So I think, to that extent, it's different. I mean, I think after the GFC, everybody sort of started thinking, well, what happens if we have, international market volatility of that sort of nature again? That's one thing to plan for. Having to get all your people out of an office for a short or a long term, that's another thing to plan for. But when you're planning for those 2 things, plus all of the other impacts that we've had, regulation, law change on the run, just all of that sort of stuff, I think most businesses I'm involved with are having a bit more of a broader look at whether it's called pandemic or whatever it is, but some sort of broader risk that incorporates, a few things happening all at once and with a pretty, globally devastating sort of impact.
I think at REI Super, it was almost serendipitous in that we had just finished doing a review of our business continuity plans. And we had, beefed up the pandemic in there because it's mentioned in some of the APRA documentation. So we decided to do a test of our pandemic plan just before COVID hit Australia. Wow. So we had the staff. I know we had the staff working from home. We tried the whole, just notifying the staff the night before to say don't come into work tomorrow, work from home, so on. Went through the whole scenario plan. And then COVID hit Australia. So we basically said, well, stay there. It's working, stay at home. And they've not been back to the office since. So it was just one of those things that we were a little bit lucky, but definitely comes back to that, reviewing stuff constantly, looking at what could potentially be out there and then testing it.
Yeah, I think it shows
I
a
think,
lot of foresight actually, because you never know when this is going to be useful for you. In fact, one of my conversations with this CISO for the state of Michigan, I think about more than 10 over years ago, he was involved in coming up with the pandemic playbook for H1N1 virus, and that was incredibly useful now because now the government in the US is actually using that playbook for COVID-19. So you never know, when we talk about planning, BCP and all that, that's actually really crucial to always look at all the different aspects, right? And then be prepared. Sorry, Roman, you wanted to say something?
No, I was about to agree with what was saying there, but when Teresa mentioned the magnitude is different, and it's true that the magnitude is unprecedented. And I agree with the idea that it may not be the word pandemic, it's something that's an aggregate of impacting issues, but the longevity as well is something that's new. So now people have realized that it's the new norm, or at least it's going to be the new norm for the foreseeable future for the next, at least for the next, I guess 6 months to 12 months. Some large companies are saying we're not returning to the office. Some people have cancelled the lease options on other levels. For the office, because some people are saying the office is becoming more of a hangout. So it's really funny because we do a lot of policy work, and when we look at policies, so the inside governance of companies, we're moving things away from BCPs and IR plans to put them into acceptable use and working from home. And we're blurring the line between working from home is now part of acceptable use because it's just such a common occurrence. But there's a new norm so I think when we look at incident planning is, what if my incidents permanently changes the way that I do business? It is one of the questions that's really interesting to see what comes out of this COVID-19.
Yes.
I think it's all about agility, isn't it, Romain? I mean, you really got to, our business continuity management team originally was meeting on a weekly basis to make sure we were addressing stuff as it changed. Now that's dropped to 3 weekly now, but we've still kept that group going because, we see it's changing every day with what's happening in Victoria. You wouldn't have imagined, a month ago. So, you just got to keep being agile.
True. And also coverage for business continuity laws, is time-based in insurance policies. So some of my clients have insured for 3 months, because they thought business interruption would last for 3 months. Some of the health practices that can't function had 3 months or 6 months, because you imagine you can only be shut for a short while if there's a fire. But now they are learning that, you have to have business continuity laws for 12 months, maybe, just to add to Teresa's and Romain's point, that the length of the disruption is much longer.
It was very telling when they extended JobKeeper to the end of March, right? Because you say, well, that's the most expensive measure, I think, or one of the most expensive measures. So they have no interest in extending it beyond necessary. So the fact that this time around they gave it such a big run tells you where what the government is being told, when listening to the experts and advisors.
And you know what? There's a lot of interesting questions that have come in. So I'm hoping we can cover all of them, but we will try to attack them as much as possible. So there's one that came in from Neil Plummer. Thanks for that. And he actually want to express his thanks to the panel because he's really enjoying the discussion. So he wants to dive in a bit more. We talked about earlier about, the boards on super funds and their view perhaps over the next 5 years, when it comes to emerging risk. But he wants to know, how do you see the boards on super funds reacting on climate change risk over the next few years, particularly with regard to transition risk and the potential for stranded assets, reputation damage, missing out on lower cost renewables and things like that?
I think climate change risk has certainly taken a bit of a life of its own. I mean, ASIC and APRA are both sort of commenting on, making sure that people are mindful of it. In our most recent risk workshop, so like Michelle, we have one every year, and we had ours in June. We made the deliberate decision. So climate change risk had been an emerging risk on our register. So it's moved now into permanent risks, and we were grappling with whether it was a standalone risk of itself or if it just featured across multiple other risks. And we got advice we go each way, so we ended up sort of putting specific actions and risks around climate change across a number of our core risks. So reputation risk, certainly, investment risk. So I think we're very mindful of the fact that, again, through the lens of members' interests first, we've got to think both of the investment returns that are available and not sort of necessarily turn ourselves off to things that can provide a return, but by the same token, we can't invest in something that, you know, will have a short life or will ultimately end up, you know, with stranded assets or assets that, you know, we just can't sell or that become unworkable. So we've got a real balance of approach. We are Energy Super, which, you know, as an industry fund, our prime members are electrical in the electricity industry. The nominating organisation for me is Energy Queensland, which is an electricity distributor. So, yeah, we're very well aware of, you know, the impact of renewables, the impact of retiring coal-fired power stations, and how that all sort of plays into future investment portfolio, as well as the broader, you know, ESG sort of risk. You know, we're looking at becoming a PRI signatory, I think, within the next few months. So we're sort of taking on board a number of those elements of that, including climate change. But for our perspective, it's multifaceted. It goes across, you know, probably 4 of our main 11 risks that we track. But as I said, we've made a deliberate decision that it's not emerging anymore. It is well and truly here, and that's the way that we're treating it.
Yeah, couldn't agree more, Teresa. We've done the same. The climate change has definitely moved from emerging to part of the permanent risks that we look at. We're also looking at our ESG policy. With the last 2 board meetings, we've been discussing the changes we need to make to that. We're currently doing a product review. So, you know, what do we need to do in terms of member demand for sustainable investments? So starting to look at where that's at, a bit like the energy industry. The real estate industry is not necessarily at the forefront of this area, but definitely we're starting to see some interest. And I think there's also, even when you look at COVID-19 and the Black Lives Matter, all those sort of activist movements that are on at the moment, they're all interconnected because climate change impacts the poorer communities, the people of colour, those sort of areas first. So we're seeing that now, and that's the sort of thing that as a risk, you know, we need to be looking at board level.
That was an interesting question that Jenny asked, and I'm also really interested in that actually. I'm curious to find out, like, what's your observation, right, on having sat on so many different boards? Do you find that there is a trend where it is the board that is leading cybersecurity discussions, or is it more the executive team that is doing that in your organizations? Where do you think it's coming from, you know, discussions about cybersecurity? Who's the ones leading this?
I think it's a two-way conversation. It's about, certainly the directors have been becoming more aware. I think Romain has identified this, and Meena has as well earlier on in the conversation. And that is generating conversations with executive that might not have happened in the past, but equally the executive are up for the questions because they're also looking at it at the same time. So I don't know that I see it was one particular area started the conversation, but certainly I'm seeing the conversations are happening a lot more than they used to.
Yeah, I agree. It's a bit of a chicken and egg thing where it might have started, but certainly all of my boards are, it's standing item to sort of understand where we're at. And I suppose some of them we've been on a bit of an evolving process of, you know, appointing different sort of roles in the executive team that, you know, again, sort of many years ago might have been the IT sort of guy. Now they're, you know, CISOs and, you know, technology officers and things that are much broader, and I think much more have a broader sort of remit in terms of reporting up to the board on these sorts of issues. So again, I think, you know, the board asks the questions and can make sure that the relevant executive, you know, muscle power is there to be able to handle what they need to, and then to be able to come back to the board. So again, it's, as Michelle said, it's two-way.
Roman. Oh, sorry, Meena, you wanted to say something.
No, go ahead, Meena.
Yeah, I agree with Teresa. It's been a sort of a two-way conversation. And like Michelle said, that the executives have an equal part to play in the conversation. I just feel that there's a bit of a shift because privacy, if you talk about trust and you talk about reputation, then the board gets entrusted because the shareholders come in, and reputation, you know, I mean, after a cyber attack or be it any adverse event, we see the impact on stock prices, etc. So if we feel that the board gets active there because reputational laws and with conversations around privacy being a civil right, that getting impacted, the boards want to project a reputation that's responsible, because the board is responsible, and therefore we feel with those sort of issues, the board is more active, the board is more vocal, and rightly so. And when we have the conversation around ensuring reputational laws as a standalone laws, we're just more interested in talking to the board, because we feel that reputation is owned by the board as a risk. So from an operational perspective, cyber will always have the IT interface and the executive interface. From a non-operational and strategic and risk management perspective, there are strands to it which fall within the scope of the board's responsibility. Romain, do you agree to see that?
Yeah, no, I wholeheartedly agree. I think that it shows the importance of articulating cybersecurity matters in a way that makes sense to the business. And that's another thing that I keep preaching right, left, and center. And say, if you can't articulate it in a business fashion, then maybe it's not a risk. And sometimes I see people think, technologists saying, oh, this piece of technology is going to come crashing. And you ask the so what test, so what, so what, so what. And after a few iterations, you realize that, okay, well, yes, it's something we want to avoid, but it probably isn't a risk that the board needs to control. So back to Mina's point, you're right. The minute we make the connection between cybersecurity and assets that the board is there to protect and to develop, then we have the board leading that conversation. But until we can make that relevant connection, and that's on the executive and on the IT team and on the security teams to make that relevant, then it's hard to have that sort of level of board involvement. It's been shifting. Everybody, I hope, yes, it has been shifting, but we're not. I don't feel we're there yet, particularly outside of the financial services industry, because of what we mentioned earlier, which is the appreciation of risk is not the same in all industries.
Very well said. Yeah, and it's different. I feel like based on what I'm seeing as well in all the different conversations, there's an evolving happening and a change of mindset, but it's taking a while to cross different sectors, different countries, and it takes conversations like this and a conscious effort from the executive team to really try and bridge that gap with the board. And some of the board directors have said, there's only some elements of cyber risk that they understand, right, at the end of the day, because it's such a complex matter, it's so broad. But it would really help if we can, put together something that's a bite size for them, right? Maybe the top 10 things that they need to know about cyber risk. And that will make it so much easier. And that's something that CEOs have requested or board directors have been asking. And maybe that's a discussion for another session. But yeah, that's something that we are seeing, which is really interesting. But we only have time left for just one last question. And I'm just going to give that to Jamal. He's asking about AML, ESG, and Modern Slavery Act. They're all in a mix of regulations of super and investment sectors. He wants to know what's your thoughts and comments.
So we have a pretty, I think it's a pretty robust tracking system that goes through our governance and compliance report that we receive that, looks at all of the obligations that we have, particularly I suppose the regulatory ones. ESG perhaps is the one that's not quite as obvious in that list. AML and Modern Slavery Act, we've got legislation to refer to. We track against it very carefully. ESG, again, probably back to some of the comments more in climate change, although it's obviously broader than that, and sort of taking in more of the observations about, some of the Black Lives Matters and other sorts of more social and economic sort of issues that are going on at the moment, which is why we're sort of looking at signing up to the PRI principles.
Yeah, I don't think I could add.
Okay.
We're doing the same.
Yeah, that's really good to know. And I think with that, we've actually come to the end of the session. I have seen a lot of comments coming in where everyone's just thanking actually the panels, the organizer. Thank you, Meena, and for all your insights. It's Yeah, they're all saying, expressing how interesting the discussion was. I'm so glad to hear that you guys enjoyed it. So thank you very much for staying here with us all the way. And a huge thank you to Meena for organizing this. And a big thank you to Roman, Teresa, and Michelle for your time. Like, really appreciate you all taking time out to just share extensively from all your experience and your observations as well. It has been very, very helpful. Any last words, people?
It's been a great conversation. Every time I do one of these, I learn something myself as well. So thank you. It's been good.
Oh, that's really good to hear that.
Thank you, Teresa. Thank you, Romain. Thanks, Michelle. That was great.
Thanks, Meena, for putting that together.
And thank you, audience, for all your questions. Really appreciate it. Thanks, Jenny, for staying all the way too. So, all right, we'll see you guys again at one of these sessions. We'll make an announcement. I'll send you the recording when it's out. And in the meantime, enjoy the rest of your day ahead. Have a good one. Cheers, everybody.
Thanks, Shamane. Thank you.
Thanks.
Bye.
Bye.
Bye-bye.